Position sizing is one of those principles that traders often brush aside, yet it governs the very heartbeat of a campaign. And today, I want to take you deeper into this idea, not as a dry rule, but as a living, breathing part of your market operation. Before we begin, let me say this. Much like we discussed in the previous video on Stop Buying the High 5-Volume Signals You Must Know, today's lesson reaches into that same vein of disciplined market behavior. Every principle supports the next, and this one sits right at the center of intelligent speculation. Now, when Jesse Livermore spoke of protecting capital, he wasn't uttering some poetic phrase. He meant it quite literally. He knew that the market rewards the trader who survives long enough to take the right positions, and that survival hinges on one rule above all: take only the size of commitment that your judgment can truly handle. I wonder, have you ever taken a position so large that it made you stare at every tick as if your very future depended on it? If so, you've seen firsthand why position sizing can either steady your hand or destroy your judgment. Livermore understood that the market is a mechanism of pressure. Every share you hold, every contract you commit to adds emotional weight to your decisions. Too small a position, and you won't care enough to manage it properly. Too large, and you'll be governed by fear instead of logic. The balance between these two extremes is where mastery lies, and that balance depends on knowing the character of the move you're engaging with. Whether it's a potential markup, a testing phase, or a position that should be handled with the lightest of touches. Tell me, have you noticed how your emotional temperature changes the moment your size is mismatched to the situation? When I studied the market's operators, I discovered that the greatest traders all used size as their quiet weapon. They never spoke loudly about it, but they wielded it with precision. You might see a chart and think the lesson lies in the price bar or the volume spike, but behind that is the operator adjusting exposure. Size reveals conviction, and conviction must be earned through study and observation. One cannot simply declare confidence. It must come from the tape itself. And if a trader increases size without a sound reading of the market's condition, he is not speculating, he is gambling. Does that thought unsettle you a bit? But let's talk about the practical nature of Livermore's approach. He never started large. Instead, he tested his position the way a good operator tests the market for supply. He would place a small unit first, watch how the market absorbed his action, then add only if conditions continued to confirm his judgment. This incremental method kept him from being overwhelmed while allowing him to build into strength. It's a principle you can adopt immediately. Just ask yourself, would your trading look different if you treated your first entry as a test rather than a final decision? This is where the mindset comes in. Not the vague motivational kind, but the mindset tied directly to market logic. You must think like a campaigner, someone who enters the market with a plan to expand only when the market proves him correct. Too many traders think the size must be decided at the very beginning, and that is where they stumble. The market is a dynamic battlefield. You do not charge in at full force unless the path ahead has been cleared. Do you see how that parallels what we learned about avoiding the highs in our previous discussion? Poor timing and oversized positions form a dangerous combination, and remembering those 5-volume signals helps you avoid stepping into strength that is already spent. Position sizing also ties directly to your ability to withstand drawdowns. Traders instinctively understand this, yet they often ignore it in the heat of opportunity. When a position is too large, a minor natural reaction feels like a catastrophe. When it is right-sized, that same reaction becomes information. And that information is the bedrock of campaign management. It's remarkable how different the same chart can look when your emotional capital isn't drained by oversized exposure. Have you ever reread a chart after reducing size and suddenly found it far more clear? Another principle Livermore followed was to never add to a losing position. This was not stubbornness. It was discipline. Adding to weakness magnifies the strain on your judgment. If the market is acting contrary to your initial idea, why would increasing your commitment improve your ability to read it? In Wyckoff terms, weakness must be confirmed before you ever operate on it, and strength must be confirmed before you ever add to it. A losing position is not confirmation, it is a warning. Yet, how many traders double down because they can't accept the possibility that their first read was wrong? Have you ever caught yourself doing exactly that? Let me remind you of something essential. Your capital is not merely money. It is your stored opportunity. When Livermore protected his millions, he wasn't clinging to a pile of cash. He was safeguarding his ability to act when the real moves appeared. And those real moves often come when the market is quiet, dull, or moving in subtle preparatory phases that require patience and a readiness to strike. If your capital is tied up in oversized, stressed positions, you cannot respond. So the true purpose of position sizing is to maintain flexibility, which is one of the trader's greatest assets. Can you think of a time when you missed a great move simply because your capital was locked in something you believed had to work? As the market unfolds, position sizing becomes an ongoing dialogue between you and the tape. Every bar, every test, every sign of absorption or supply creates information you can use to adjust. And the beautiful thing is that this constant adjustment cultivates a kind of calm. When size is appropriate, the market becomes readable. When size is excessive, the market becomes distorted by your own fear. You cannot read a chart correctly if your emotions are fighting against your analysis. This is something Livermore and every great operator learned the hard way. Are you willing to let the market teach you the same lesson gently, rather than brutally? And as you grow in your market studies, you will find that proper size naturally supports proper timing. Because when you're not overcommitted, you don't rush. You don't chase. You wait for the market to come into alignment with your plan. This waiting, not passive, but analytical waiting, is where the trader develops maturity. It's the same patience we touched on when discussing volume signals that warn you away from buying highs. The two ideas intertwine more deeply than most imagine. Position size should grow only as market behavior confirms your initial judgment, and this idea reaches far deeper into trading than most realize. When you first step into a position, you are not declaring certainty. You are initiating a conversation with the market. You are asking, quietly and with respect, am I seeing the truth here? Because no matter how skilled your analysis may be, the market always has the final word. And the wise trader treats that first entry as a probe, a small feeler sent into the stream to test the current. If the current flows in your favor, you add. If not, you step aside before any real damage can occur. It's remarkable how simple this sounds, yet how rarely it is followed. Most traders make the mistake of committing too much too soon, as though the chart owes them a smooth continuation simply because they recognized a potential pattern. But markets don't reward early boldness, they reward adaptive thinking. If the market confirms your judgment through strength, follow through, or a clean response to a test, then size becomes your ally. Think of that early position as a scout on unfamiliar terrain. You don't send your entire force over the hill without knowing what's waiting on the other side. But when the scout reports favorable conditions, that's when you reinforce the advance. Trading works the same way you reinforce ideas that the market itself validates. Consider how differently your mindset behaves when your first entry is intentionally small. Instead of feeling fear at each tick, you observe more objectively. You're listening to the market rather than arguing with it. That calmness is not an accident. It's the natural result of controlling exposure. When your initial size is modest, you grant yourself emotional room to read the unfolding action. If the market rallies smoothly, with volume supporting the rise, and reactions are shallow and orderly, that is a market saying, yes, your judgment aligns with the underlying forces. In such a moment, adding to the position is not reckless. It is logical. You're simply increasing your alignment with strength that is already showing itself. But contrast that with the trader who enters at full size immediately. Every wiggle feels personal. A harmless pullback suddenly appears threatening. Instead of reading the action, the trader reacts to it emotionally. In this state, adding becomes impossible because the initial commitment already feels overwhelming. This is why so many people remain stuck in stressful trades. They didn't allow the market to speak before they committed everything. Expanding size only on confirmation prevents this trap altogether. Another powerful aspect of this principle is that it forces you to think in terms of campaigns rather than single trades. A campaign is built over time as the stock or instrument demonstrates its intention. You don't expect clarity from the very first bar after you enter. Instead, you observe how the market behaves around key areas, whether supply appears, whether demand holds, whether the action becomes smoother or more erratic. With each layer of information, you evaluate whether the idea deserves greater commitment. This creates a rhythm: small entry, market confirmation, calculated addition, further confirmation, another addition, and each increase in size is justified by fresh evidence rather than hope. You'll also notice that adding only when confirmed naturally aligns you with market strength rather than against it. Many traders unknowingly add during weakness because they're trying to fix a position that's going against them. But this principle flips that completely. You add not because you need the trade to work, but because the market is already proving that it is working. It's a method rooted in logic rather than emotion. And because of this, it reinforces discipline in both winning and losing situations. When the market shows weakness instead of confirmation, you simply don't add. The campaign stays light, manageable, and easy to exit if needed. This principle also protects your capital more effectively than any stop-loss technique. When your largest size is put on, after you already have a cushion of favorable movement, your risk diminishes dramatically. You're building size into profit, not into vulnerability. Many professionals quietly rely on this approach because it shifts the risk-reward profile in their favor without requiring any special indicators or complex formulas. It's grounded in reading the action and respecting what the market reveals. This approach also strengthens your internal psychology. When you only increase size after confirmation, your confidence grows naturally because it's supported by evidence, not imagination. And that kind of confidence is sustainable. It doesn't collapse the moment the market hesitates. Instead, you find yourself more patient, more observant, and far less tempted to force trades. You begin to understand that opportunities don't need to be chased, they need to be confirmed. Once you internalize that idea, the entire tempo of your trading changes. As you develop skill in reading these confirmations, whether they appear through cleaner structure, stronger demand, successful tests, or orderly pullbacks, you begin to recognize that the market offers clues long before it makes its biggest moves. These clues become the signal that your initial judgment was accurate, and they guide the prudent expansion of your position. Oversized positions distort chart reading by amplifying emotional pressure, and this single truth sits at the center of why so many traders struggle to make consistent decisions. When your position is too large relative to your comfort, your risk tolerance, or the clarity of the setup, your relationship to the chart changes instantly. The bars stop being information and start becoming threats. Every fluctuation feels exaggerated. Movements that should help you interpret the market instead pull you into emotional reactions. And the moment your emotions overpower your analysis, the chart no longer speaks the way it should. When your exposure is oversized, even normal, healthy reactions can feel like the start of a collapse. A simple pullback to support that would ordinarily tell you the market is behaving correctly now appears ominous. You don't see the structure, you see only the unrealized profit shrinking or the loss expanding. The market hasn't changed, only your perception has. And that shift in perception is enough to break the disciplined observer's mindset that every trader needs. The chart requires a calm, watching eye, but an oversized position replaces that calmness with urgency. You begin to monitor every tick, not because the evidence demands it, but because your nerves demand it. This distortion also affects how quickly traders abandon logic. When size is too large, the trader often reacts prematurely. He cuts winning trades too soon, fearing the inevitable pullback. He also holds losing trades too long, hoping they will turn around because the pain of closing them is too great. In both cases, the emotional burden of oversized exposure overrides the ability to read what the market is genuinely communicating. The chart becomes secondary to the trader's internal discomfort, and when that happens, the ability to interpret price and volume accurately is compromised. It's important to understand that this emotional pressure doesn't come from inexperience alone. It comes from carrying a load that was never appropriate for the moment. Even a skilled analyst can misread a chart the instant his size is too big. Fear and hope begin to color the bars. Volume spikes look more dangerous than they are. Minor weakness looks catastrophic. Rallies feel relieving rather than informative. Every move becomes magnified through the lens of what you stand to gain or lose. This is why two traders can look at the same setup and see different things. One is calm, properly sized, and analytical. The other is oversized and emotionally compromised. Oversized positions also disrupt timing. Good timing requires patience, waiting for tests, waiting for confirmation, waiting for the right kind of movement. But when the position is too large, patience evaporates. The trader starts rushing decisions, entering too early to escape the discomfort of waiting, or exiting too soon because each moment in the trade feels heavier than it should. This leads to choppy trading, random exits, and entries driven by anxiety rather than alignment with the market. And once the rhythm of timing breaks, even strong setups can turn into disappointing results. Another subtle consequence of oversized positions is how they distort the trader's ability to recognize higher time frame structure. When you're under emotional pressure, you stop seeing the broader picture, the phase the market is in, the nature of the trend, the presence of supply, the signs of absorption. Instead, you become hyper, focused on the smallest fluctuations. You shrink your perspective to the 1 minute or tick chart, not because it adds value, but because you're desperately trying to relieve the discomfort of uncertainty. But the more you zoom in, the less you understand, because the true story of the market lives in the larger context. Oversized exposure pulls you away from that context. This emotional distortion can also lead to incorrect interpretation of volume. A trader under pressure often views any increase in volume as confirmation against him. If he's long, rising volume on a decline feels catastrophic, even if the spread is narrowing and showing potential absorption. If he's short, heavy volume on a rally feels like a signal to panic, even if the bars show signs of supply. In both cases, volume stops being evidence and becomes fuel for fear. Proper reading of volume requires neutrality. Oversized positions destroy that neutrality. Even trade management becomes difficult. Scaling out becomes inconsistent. Adjusting stops becomes reactive instead of strategic. You no longer manage the trade based on structure. You manage it based on pain and relief. And this cycle repeats until the trader either reduces size or blows up the account. The trade becomes about emotional survival rather than execution. And once trading becomes emotional survival, the analytical framework that Wyckoff, Livermore, and the great operators relied upon can no longer function properly. The saddest part is that oversized exposure tricks the trader into thinking the market is more volatile than it really is. The volatility is internal, not external. The chart is doing what it always does, moving through phases, testing levels, shifting from supply to demand. But when size is too large, the trader interprets ordinary movement as extreme movement. This misinterpretation leads to poor historical memory. Each large fluctuation feels like a rare event, even though it's simply part of the usual ebb and flow. The trader learns the wrong lessons because he experienced the chart through emotional magnification rather than objective observation. And this is why proper position sizing is not merely a risk management technique. It is a clarity technique. It protects your ability to read the market. It keeps your emotional state in harmony with the pace of the price action. It allows the chart to show you what it is truly doing, rather than what your fears or hopes project onto it. When your size fits your plan, the bars regain their meaning. Volume becomes information again. Structure becomes visible. You can wait, observe, analyze, and respond with composure. You can see both the small movements and the big picture without feeling overwhelmed by either. The first entry should function as a test, not a full commitment, and this single principle can change the way you interact with the market more than almost anything else. When you treat your initial position as a test, You remove the heavy expectation that the trade must immediately perform. Instead, you shift your mindset into observation. You ask the market to show its hand before you expand your involvement. This approach, long used by skilled operators, encourages patience, clarity, and adaptability, qualities that are difficult to maintain when you begin with a full-sized position. Think of that first entry as a question, not a declaration. You're essentially saying to the market, "Is my analysis here aligned with the underlying forces?" And the market will answer, but it answers through behavior, not through guarantees. If your entry is sized lightly, you give yourself enough psychological space to listen. You can watch how price and volume react around your level. You can see whether supply appears, whether the move stalls, whether demand confirms your idea, or whether the entire premise was premature. This test entry allows you to evaluate without pressure because you haven't yet risked more than your analytical confidence can support. One of the greatest advantages of using a test entry is that it makes you more sensitive to the nuances of the tape. When your exposure is small, every bar becomes information rather than emotional stimulus. A slight shakeout is not a reason to panic. It's something to study. A shallow pullback isn't an attack on your position. It's a clue about the strength of the underlying trend. A pickup in volume isn't a threat. It's a signal to interpret. Because your initial position is light, you can afford to focus on reading instead of reacting. Most traders rush into full size because they fear missing the move. They believe that if they don't take a large position immediately, the market will run away without them. But this fear is misplaced. Markets rarely move in straight lines, and even when they do, there are always opportunities to add when behavior confirms your idea. A test entry isn't about reducing your potential reward. It's about increasing your probability of staying aligned with the correct side of the market. The large moves that traders dream about seldom happen instantly. They unfold in steps, phases, and waves. A test entry allows you to participate early while still leaving room to expand intelligently. Another powerful effect of treating the first entry as a test is that it protects you from your own biases. When you enter small, you're not as attached to being right. Your ego doesn't grab hold of the trade as tightly, so you can exit quickly if the market contradicts your thesis. You're not defending a large position, you're simply gathering information. If the market moves against you right away, you don't feel compelled to give it more room, out of desperation. Instead, you can calmly say, "The market didn't confirm my idea. I'm stepping aside." And stepping aside becomes easy when your size is light. This testing approach also supports the idea of building a position, which aligns with how real campaigns develop. Large operators don't buy or sell full size immediately. They accumulate or distribute over time as evidence reveals itself. You, as a smaller trader, can mimic the logic if not the scale. Your test entry is the beginning of accumulation, and the market's response determines whether you continue. Strong movement with clean structure, add. A test of supply that holds, add. A successful spring or shakeout followed by strong demand. Each addition becomes justified by behavior, not by hope. The beauty of this method is that it naturally encourages discipline. You can't add recklessly because you're waiting for confirmation. You can't get stubborn because the test entry doesn't carry enough emotional weight to trap you. You can't average down because the entire principle is built on adding only when the market proves strength, not weakness. And because you're building into a working idea rather than forcing size into a failing one, your risk curve becomes healthier and more controlled. When you operate this way, the market teaches you. It shows you whether the trade deserves more commitment. It shows you whether the move is genuine or merely a temporary fluctuation. And it shows you when the environment is too uncertain to expand. The test entry becomes a tool of communication, a way to stay in sync with the tape. Instead of fighting the market for clarity, you invite the market to reveal clarity through its response to your presence. This approach also helps you internalize patience. Once you learn to value confirmation over impulse, you no longer feel rushed. You're not competing to be the first one in. You're positioning yourself to be the one who stays in when the real move begins. And staying in requires confidence. Confidence that is earned through watching the market validate your original idea. That validation begins with the test entry. Without it, every trade becomes a leap. With it, every trade becomes a conversation. And there's a final layer to this principle that becomes clearer with time. A test entry is not small because you are timid, it is small because you are strategic. It's a deliberate choice to observe before committing. It's the mindset of a campaigner rather than a gambler. It's the recognition that markets reward adaptability, not early aggression. Position sizing aligns conviction with evidence, not with hope or impulse, and this simple truth separates the thoughtful operator from the emotionally driven trader. When you decide how much to commit based on what the market has proven, rather than what you wish it would do, you shift from gambling to disciplined speculation. Conviction in trading is often misunderstood. Many believe conviction is a feeling, an emotional certainty that they are right about the trade. But real conviction is not emotion. Real conviction is the confidence that arises after the market itself has demonstrated behavior that validates your idea. Evidence first, size second. That is the proper sequence. When your position size reflects actual market evidence, you give yourself room to operate without emotional strain. Too many traders build size based purely on enthusiasm. This chart looks good. Or, I just know this is going to break out. Or, this stock is overdue for a move. But enthusiasm doesn't protect your account. Hope doesn't reduce risk. And certainty that exists only in your own mind tends to collapse the moment the market makes a contrary move. Evidence-based conviction, however, stays steady because it isn't built on imagination. It's built on what you've seen the market do. Think about how differently you behave when your size stems from clear confirmation. Maybe demand stepped in at the level you identified. Maybe volume expanded precisely where it should. Maybe the reaction was constructive and shallow, showing absorption. Maybe the breakout was supported rather than emotional. When you increase size after witnessing behavior like this, you do so calmly. You aren't forcing anything. You're aligning yourself with strength the market already revealed. The trade feels cooperative rather than stressful. You're not pushing, you're flowing with what's unfolding. Now compare that to sizing based on impulse. Impulse is all about wanting the move to happen now. You see a hint of strength and your inner excitement jumps ahead of the chart. Instead of waiting for confirmation, you load up because you fear missing out. You call it conviction, but really it's impatience disguised as belief. And as soon as the market hesitates, because all markets hesitate, your so-called conviction dissolves into anxiety. You didn't build size on evidence, so you have no evidence to support your emotional stability in the trade. The foundation is missing. When conviction is evidence-based, even the natural pauses in the trend make sense to you. You don't panic when volume shifts or when price pulls back slightly. Instead, you evaluate, is this reaction normal? Is supply showing up? Are buyers stepping in where they should? You're reading the chart rather than projecting fear onto it. Evidence keeps your reasoning intact. Impulse distorts your perception. This alignment between conviction and evidence also leads to better timing. When you wait for the market to confirm your idea before increasing size, you naturally avoid the dangerous habit of entering too early. Early entries feel exciting, but they often force you to endure noise that wasn't necessary. A market that hasn't confirmed direction yet moves in unpredictable ways. Evidence-based conviction protects you from this by nudging you to wait for conditions that actually deserve commitment. And once those conditions appear, adding size feels rational, not forced. Another powerful advantage of this principle is that it teaches you how to operate like a campaigner. The operators who accumulate positions don't do it because they feel strongly. They do it because the market's structure is unfolding according to their expectations. They observe how price behaves at support, how volume appears on declines, how demand returns after shakeouts. Each confirmation increases their conviction, and each increase in conviction justifies additional size. They don't leap, they layer. They don't hope, they measure. and they don't assume, they validate. This is the mindset you cultivate when you tie position sizing to evidence rather than emotion. This also protects you from one of the most dangerous tendencies in trading, the urge to average down. Hope-driven traders often add more size as the market moves against them, because they emotionally need the trade to return. But evidence-based traders do the opposite. They add only when the market moves with them, because that is the only time conviction grows. A losing position isn't evidence of strength. It's evidence that your idea isn't aligned with the present reality. Adding into that is the opposite of conviction. It's denial. Evidence frees you from this trap by making your decisions conditional on the market's behavior rather than your internal narrative. There's another layer here too. When your conviction is evidence-based, you develop a more stable relationship with uncertainty. You accept that the market doesn't owe you any immediate confirmation, and you learn to wait without tension. The waiting becomes analytical rather than emotional. You watch for behaviors that either confirm or negate your idea. If the market never confirms, you stay light or stay out, and there's no turmoil because you didn't commit size prematurely. Conviction, in this sense, becomes a byproduct of patience and observation. This approach also refines your ability to interpret failure. When you tie size to evidence, a lack of confirmation becomes valuable information. It tells you not to expand your exposure. It tells you to stay alert. It tells you the setup may need more time or may fail entirely. Evidence-based conviction makes you sensitive to subtle weaknesses and prevents you from overstaying ideas that are losing structural integrity. When your size remains small during periods of uncertainty, errors become manageable rather than catastrophic. And perhaps the most meaningful effect is how this principle shapes your identity as a trader. You begin to trust the market more than you trust your impulses. You allow the chart to guide your decisions. You stop trying to impose your will on price. Instead, you respond to what is real. Conviction becomes something you earn through study and observation, not something you manufacture through excitement or fear.